Hey guys, All in Crypto here, and welcome back, ladies and gentlemen, for another YouTube video. I'm wishing you all, or hoping you've all had a great weekend. This is just going to be a very broad cryptocurrency market update. We're really going to be analyzing the market, really touching on a lot of the things that we've been mentioning over the past week or so in regards to this rally. And just stressing the fact that, yesterday we made a video called It's a Trap, or something like the trap has been set. And I do believe, and this is a bias that we've maintained, that this bear market is still intact. And the sort of macro conditions that we find ourselves under are going to lead to further pain for the cryptocurrency market. And even though we're longing this market, and by the way, guys, I had some comments yesterday saying you're really going to miss out on this rally. I'll trade the market short or long. Doesn't make a scrap of difference to me which way it goes from a day trading and a swing trading perspective, because I'll capitalize on whatever moves that I can get. This is what separates me from many of the other market analyzers out there. Even though I have a bias that we are still in a bear market and we are going to see the eventuality sort of lead to downside, and we've sort of likened longing the market right now to playing Russian roulette, we will trade it both ways. And we've been very accurate calling from the short squeeze at 15k to where we currently are. We've actually called for this, and it's played out exactly as we've called it. We're right on this occasion. I'm sure we'll be wrong on many others. So we are actually playing this upside. However, it's very much, in my opinion, a trap that has been set. And it's what we're going to talk about in this video because, and we'll do some short-term technicals on Bitcoin. I just want this to be a broad one. It's Sunday. It's a nice chilled out day for most of you, hopefully. But ultimately, a trap very much has been set out. And this bullish div that we had on the weekly was something that I have to take seriously. I have to expect traders to also take this seriously and look to ride it to the upside. And we also compared the last bullish div that we had, which was here, leading into March 2020, to where we currently are. And I think you're looking at a very similar scenario playing out. So whether we retrace this whole FTX spill, in my opinion, this should have spilt significantly harder, given the fact that we consolidated for 150 days. Essentially, what I think you're going to get is you're going to get a retest of this grind line, and then that's going to lead into the eventuality and sort of further continuation. It's going to set you up for the next leg lower. When everybody's bearish, the market doesn't really have that many people to take liquidity off of. So it's going to trick people. I'm not sure what this draw is, but when we get down the time frames, we'll look at it. It's going to trick people into getting bullish again. I've seen so many people come out and say how bearish they were on this spill. And then we got this, and then we looked to essentially find we were short here, shorted this FTX spill, called it. Then got short on the more immediate time frames on this grind line, got out of our short position, then called for a rally, a short squeeze. And we've had a continuation of this. We even called for, when we had the non-farm payroll data, which logically should have been negative for markets because it's going to sway the Fed into being more aggressive. We actually look, you're going to get a short squeeze again. People are too short. The market doesn't like that. It's all about taking money off people. And this is why a large part of the reason we've had this rally upwards. It's not because this is the generational bottom and the perfect entry. It's more that markets have their own mechanics and they move in a certain way. You guys are going to learn a lot more following this channel than, in my opinion, most other channels out there. And we're essentially consolidating on this support. And I think you are going to get continuation. And like I say, I do very much think, we'll look at this draw that I put on from yesterday's video, that potentially something like this is in play. It is very much playing Russian roulette because this could literally be it, and we could get something that takes it to the downside. The dollar has had a horrific time, ladies and gentlemen, but in my opinion, it will reassert. But on what news or what grounds does it reassert? That's going to be the interesting thing, and this is essentially what I think is going to play out. You're going to get a sort of softer dollar like we've seen. It's going to propel the rally. You're going to get traders behind it. Up here, if we did get here, everybody would flip bullish. And this is where we take it short and look for that downside, because there's very much a sort of sigh of relief when we're looking at inflation, where we're looking at economic data, because people are now pricing in the Fed's rate that they want to see inflation come down to, sort of by mid next year. I actually happen to think that's not going to be the case. If you look at what's going on in China, if you look at what the sort of lay of the land is globally, I think we have moved away from, it's a different world from March 2020 onwards, really. I think a lot has changed. And I think that inflation is actually going to stay a little bit more persistent. It may come down more than it already has. I think that's actually quite probable. But it's going to stay a little bit more niggly, a little bit more annoying for longer. And I essentially think that you know, with the two damaging forces that we have of inflation, it really hurts consumers, and a higher interest rate, which of course takes liquidity out of markets, as that liquidity is then needed to pay off a very over-exaggerated and colossal debt market. We are looking at potentially further downside, and markets generally have been supported by the Fed really since 2008. And I just want to stress that and really drill that point home. You know, markets are liquidity junkies, or markets are a liquidity junkie. And by liquidity, we're just talking about capital. We're talking about money. You know, this is the M1 money supply, and you can see really it's inflated, and assets have gone in the same direction. This is the S&P in the sort of candlesticks, and then this, of course, is the money supply in the orange. Markets have very much been supported by this, and we're in this alternative reality now, or the adversary of the conditions that support markets into conditions that actually dictate that they are going to come lower. And I think this is still the play broadly, and it's really the side that we're trying to keep people on. So yes, we do think a rally is coming, or going to probably has a very good probability of continuing. It's just probabilities. At the end of the day, I could be wrong, and we'll ultimately know that given the support levels that we've got. But I think this rally will continue, but this rally is going to set people up for that next leg lower and potentially the final capitulation in this bear market. So it's going to be a very interesting couple of weeks. It looks like we're very much having a Santa rally. You know, we're getting all this data come out. This is from Andreas Steno Larsen. I think this guy, is he potentially one of the Real Vision guys? By May next year, goods inflation will have disappeared. This is China to US freight rates versus good inflation. So I don't think these guys are necessarily factoring in this sort of zero-something policy that's going on over there. We also have, this was from Morgan Stanley's core CPI, US CPI over the 12 months. They're also predicting it to come back down between your 2 to 3% levels. I think they're going to get a shock, and I think markets are now, given the fact that the Fed came out and said, look, we're going to be a little bit slower, and the fact that we're seeing inflation come down, are sort of taking this as a sigh of relief, which sets up the perfect sort of precursors for a relief rally, only for something to come and potentially see that further continuation to the downside. You know, I just want to pull this up again. This is the yield curve, the 10s and 2s, and this is something that haunts me and stays very much on the forefront of my mind, because we have not had the fallout of the steepest yield curve that we have seen as of yet. And every time we've had this inversion, when we go between under the zero line, there's been some sort of an economic fallout or crisis on the back end of it, and we've still not seen this one play out as of yet. And my suspicion is it's going to be a particularly nasty one, and we want to stay out of the way of this. This ties in with our thesis that you're very much doing what you did from March. You're very much repeating the setup that you had going into March 2020, and there's going to be a big capitulation event that's going to be not crypto specific, but more broadly market specific. So it's going to be an economic sort of Lehman's moment, if you will, that's going to take place, and that's going to see us potentially see those lower prices. Now, there's the adverse of that. Maybe that doesn't happen. You know, we're sort of speculating on things that haven't happened yet, but we will see this. You know, we'll see reversal structures take place, and given the fact that we got out round about here for Bitcoin and many of our altcoins, we've got plenty of time to get back in. You know, I think people think that I don't want this to be the bottom. I would love nothing more for this channel, for my sort of self, than for this to be the cryptocurrency market generational bottom. Because that means engagement goes up. You know, I can start being an investor again and make money via that, rather than having to trade the market. And also trading becomes a lot easier in a bull market. But I just don't think it is. So it doesn't benefit me necessarily for this not to be the bottom, other than I'm positioned obviously against it being the bottom. But we've been out for a long time now, and would be happy to get back in here if we saw reason to do so. Those reasons, in my opinion, are not present. And until they are present, until there's some sort of a change, until there's some sort of a reason for us to buy back into this market and understand that markets are going to be supported moving forwards, we keep on keeping on until there's reason to suggest otherwise. This is something I tweeted out yesterday. My opinion might be wrong. We haven't seen the worst of what's coming. The liquidity vacuum caused by the percent of the debt market hasn't even begun to show yet. And this is the 30-year fixed mortgage rates. They've got them sat around about 6.4%. You know, we haven't seen these sort of levels for a long time, and markets have been loving this on the way down. It's likely to suspect that they're going to not act very positively on the way up. And there's still, I think, a little bit more rope to be given out by the Fed before they really tighten it, and that noose gets sort of comes into play. And I think this is very much what we're looking at moving forwards, guys. It doesn't have to get up here. It could fold here. You know, certainly when we get to the 18K level, we're going to get some sort of resistance. But I think depending on how the futures market opens tonight is going to be very telling. So I'll be watching the intrabank rates for the dollar pairs, and also, of course, the stock futures. Now, stocks, I mean, that is a very significant wick, in my opinion, which is showing clear interest here. And I actually think that stocks potentially are going to see a little bit of further upside before we get that downside. This is still, in my opinion, very much a 2008 playbook. And I think we've done all this analysis before heading into a similar situation where we get that drop. This lines in with our thesis that we're going to get a little bit higher, and then we're going to get that drop, and then we can maybe start to see recovery. Maybe the Fed look to pivot here on the back of something breaking things. Whenever the Fed have typically pivoted and reduced their rates, markets have dropped with the rates, actually. So a pivot narrative is something that we really need to look into moving forward. We'll do a whole video on that. I'm going to be covering it with my Patreon tonight. Anybody that's interested in joining my Patreon, there's a link in the description. Check it out. This is the core risk model for the S&P, and you can see where we currently are. And if you look at where this is in terms of to the upside, you can see areas where we've been this high previously. Typically, it shows an element of risk that people potentially aren't expecting. So that's all I've got for you. We've given the short-term play, we've given the mid-term and the long-term play. Ultimately, mid to long-term, we do expect more downside. Short-term, we do expect this rally to continue. We've been very accurate in calling it so far. We've even laid schematics of how we think it was going to play out and what it's going to look like. We gave this as a sort of scenario. And we've still yet to have potentially this move here on the back end of this. So we're chopping here, and then maybe we get some sort of a run, something like that, and maybe that's it, and we don't get as high as we're looking at over here. All I've got for you in this video, guys. You enjoyed the content, like, so appreciate it as a comment, and I look forward to seeing each and every one of you in the next YouTube video. Thanks a lot for watching, guys.